In lesson 8-1, we're going to be doing something called closing entries. So lesson 8 is going to be wrapping up our first semester and also wrapping up our proprietorship. So this is the last we're going to see of Delgado Web Services is in chapter 8. So we're going to be journalizing and posting closing entries. I think it's important to see the accounting cycle. So this is how far we've come from the very beginning of the year to now. So the accounting cycles includes everything that you do from start to finish in a fiscal period as an accountant. So there are 8 different steps. Step 1, we analyze transactions. So in chapter 2, we learned what's a debit, what's a credit, what is an asset, a liability, owner's equity, etc. We just learned what things were. Step 2, we learned to journalize in chapter 3. In chapter 4, we learned how to post. In chapter 5, we prepared a worksheet for the first time. Chapter 5 and chapter 6 and chapter 7, we prepared financial statements. So that was our income statement and balance sheet. And then in chapter 8, we're going to journalize and post closing entries, which is what we're doing right now in lesson 8-1. And then we are going to prepare something called a post-closing trial balance. So these are the last 2 steps of the accounting equation that we are going to get to in lesson 8-1 and 8-2. So we first need to know something called permanent accounts and something called temporary accounts. This is really important because this helps us know what accounts we need to do closing entries for. So permanent accounts, those are used to accumulate information from one fiscal period to the next. So that's our assets, our liabilities, and our owner's capital account. These are permanent. Our assets, such as cash and supplies, if our fiscal year is January 1st through December 31st, we don't start every year, get rid of all the cash that we have, get rid of all the supplies that we have, and start fresh. No. Permanent accounts, we use those same balances from the end of one year to the start of the next. So assets, liabilities, and the owner's capital account roll over from one fiscal period to the next. This is unlike temporary accounts. Temporary accounts are used for just one fiscal period, and these values, these account balances, are transferred or closed into the owner's capital account. So they aren't going away entirely. They're just being pushed into another account because they're temporary. We want to start the year, January 1st, and we want our sales to be just for that year. We want our expenses to be just for that year. We want our net income and net loss to be just for that year. Same thing with our drawing account. So these 4 accounts, revenue, expenses, and net income or loss, and the drawing account need to be started fresh every fiscal period. So in order to do that, we need to close them out at the end of the year. So closing entries, these are the journal entries used to prepare temporary accounts for a new fiscal period. So those temporary accounts that we just talked about, that we want to start with the 0 balance, we need to do something called closing entries. So why do we do this? Well, we're now using that income summary account for the first time. So we are going to have net income that we are going to put into the income summary account as a credit balance. Just like we always credit sales, always, we only have that special account column for sales credit. When sales are larger than expenses, then we're going to credit the income summary account. When total expenses are greater than revenue, which is a net loss, then we debit the balance. So if expenses are larger, just like we always debit expenses, if expenses are larger, we'll debit the balance. So that's going to make more sense as we get in here to our very first closing entry. So we're going to do a closing entry for an income statement account with a credit balance. So we want to close out the balance for sales. So sales has a credit balance because that is the only thing that we ever do to sales is credit sales. So we need to first start out with our heading, closing entries. Notice that's centered in our journal. And we know how to cancel out a credit of $5,820. We cancel that out with a debit of $5,820. So our closing entry is going to start out with the date and a debit of $5,820. So to close out the credit of $5,820, we debit it with a debit of $5,820. And then the other half of our closing entry, we put into income summary. So a credit to income summary, $5,820. So you can see up here in our T-chart, we started with a balance of $5,820 credit. When we do our closing entry, a debit of $5,820, our new balance is 0. That's the whole goal of all of our closing entries. Next, we need to close out all of these expenses. So all of our expenses have a debit balance. We always debit expenses. So in order to cancel out that debit, the debit value, we need to credit those accounts. Starting with the last date of the month, we're going to do income summary. That's always the other half of our closing entry. The total amount of all of those expenses is what we're going to debit to income summary. To cancel out or to zero out a balance for advertising expense, a balance of debit $397, then we need to credit advertising expense $397, and so on for all of these expenses that are debited. In our closing entry, we're going to credit them. That will zero out their account balances. That's the whole reason we do closing entries. Next, we need to close out our net income. So if we have net income, we are going to first credit our capital account because we're adding money to our capital account. We always credit our capital account. So we're adding that income to the capital account. Capital account increases with a credit, so we're going to credit it because net income increases the value of the company. So that's the first half of it. And then we always do the opposite to that income summary account. Always the last date of the month, the 31st. We have income summary debit, $3,162. And then we credit our capital account to zero out the net income to start the year, the next fiscal year fresh. We credit capital because we increase the capital account with a credit. Obviously, net income increases the value of a company. Now we need to do the same thing, but for the drawing in the capital account. So we need to close out our drawing, similar to how we did our balance sheet, where we took our capital account plus net income minus drawing. We're going to do that again. So just as we did with the balance sheet. So we're going to do the opposite of what we have up there for our drawing. So in order to cancel out our debit drawing value, we need to credit it. So we'll start out by the date. We're going to decrease our capital account by debiting it for the drawing amount. And then we're going to zero out that debit drawing balance with a credit. So we had a balance of $1,150 debit. To cancel that out, we need to credit the account for $1,150. So next, you have 3 questions at the end of the chapter. Take your time, pause this video, answer the questions, and then play the video to make sure that you have the correct answers.